morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me are Pavitra Parekh and Sumaira Abdi. Good morning, girls. Brand new week of trade, and it's looking good at the start this Monday morning. You know, the SGX Nifty was suggesting a gap down opening, but as we speak, after an opening around 17,600, we've actually moved up higher by close to about 100 points on the Nifty, while the Sensex has gained close to about 330 points. Given the context that Asian markets are struggling today, Hang Seng is down more than 1%. You've got weakness in the other Asian markets as well. Indian markets are resilient, not just today, but just take a look at India's outperformance on a year-to-date basis with the rest of the Asian markets. All the other markets are down 15 to 20% year-to-date, while the Indian markets have managed to notch up a gain of close to about 1 to 2%. So that talks about the strength of the Indian markets, and it's getting reflected today as well. But hi, Pavitra, what about individual stock sectors?
Well, today it's definitely the metal pack which stands out, right? So a few of those names will come up for you. That entire sector doing very well in trade. The real estate pack is also looking very good. And remember, if you take a look at the real estate index in the last 5 days, that one has really surged. It's up 5.8% in the last 5 days. And once again, today, a lot of the stocks are doing well. So take a look at Indiabulls Real Estate. You have Godrej Prestige. These are some of the stocks which are holding up well. Reliance, by the way, is trading well. Last week, it was one of the bigger drags on the market. But today, it is holding up, and it is one of the top gainers. On the downside, you have the Nifty Auto Pack. Of course, last week we saw that big run come through in the Nifty Auto Index. It was up 4%, but today a few of those stocks are a little bit subdued. But all in all, this is still a good looking screen. Hi, Sumaira.
Hi guys, good morning. So let's get started because we have a lot of ground to cover, and in fact we're also connected with our first corporate. And here's some cheer as well. The North America Class 8 truck orders for the month of August have come in at a strong 21,400 units, which is the highest in 5 months. Orders have actually doubled over the previous month. We're now joined by Naresh Jalan, Managing Director of Ramkrishna Forgings, to talk about business outlook and demand trends. And by the way, why Ramkrishna Forgings? Because they derive 23% of their revenue from this market. So, Mr. Jalan, thanks very much for joining in. The first thing I want to ask you is, if this run rate is going to be sustainable from here on, because in the previous 4 months, I think barring June, we had seen orders consistently dipping. So is the rise sustainable, and then this run rate of 21,000 plus sustainable?
I think, first of all, we are not much dependent on Class 8. Overall, I think 23% has come down to close to 10 to 12% only. But what we see right now is the demand is going to be sustainable. But 21,000 number, I will not be able to vouch on. But we feel that the market is pretty strong in the North America and is going to continue to the next year.
Any signs of slowdown in North America or Europe? While we understand on one hand the chip shortage issue is getting sorted, which is a positive tailwind for an industry that you are operating in, but people are talking about a hard landing, the possibility of a hard landing in US, Europe. There are concerns about the energy crisis and the impact it will have on manufacturing. Any signs, even early signs of a slowdown, according to you?
In Europe, we see some early signs, but I don't think it's going to be a hard landing. We see maybe market may go by 5 to 10% soft, but it was an unusual time right now, and things were very, very strong. I think market going down from here is not going to be very detrimental to overall supply chain, and things are going to be pretty good going into next year also.
You said 5 to 10% lower than
the peak.
Okay, only for Europe.
Yes, and North America is pretty doing well. I think we are seeing improvement in North America demand. What was vis-a-vis what we saw in the first quarter, we are seeing improvement in demand. So we feel that is going to remain strong going into next year.
All right. Hi, Mr. Jalan. Morning. So if we take a look at the entire exports for Q1, we saw a dip of around 5% in the sales volumes. You're saying North America is looking good. Can you tell us where the pressure is coming from? Is this largely on account of what you're seeing in Europe?
Yes, I think in first quarter, it was both US and Europe, but going into second quarter and going in for third quarter also projections, what we feel that US is going to remain strong. Europe is going to be little subdued, but not very down.
So what can the exports look like then going forward?
I think in an overall year perspective, we should do at least 15 to 20% higher than what we did in FY22.
Mr. Jalan, you said your dependence on the North America market has come down to now, 10-15%, right, of your revenues, not the 23% which was earlier. What is this on account of? And if the North American business is shrinking, where are you making up the rest of the exports from?
No, I don't think our North America business is shrinking. Our overall portfolio has grown, and the addition to the new portfolio has come from Europe as well as South America. So that has become basically helped us in terms of percentage wise to shrink the North American market.
Okay. I think last quarter you had order wins of about 388 crores, sir?
Yes.
Okay. Is that
approximate?
Approximate. Is that the run rate we should expect even in Q2, Q3? How have the first 2 months been in terms of order wins for you?
This month also there has been good order wins. I think probably we will see some more good order intakes in this month and going into October. And we are pretty doing well. I think, like I said, in Europe as well as South America, we are getting into new customers as well as new components. That is helping us to win new orders.
But what could be the order intake guidance for this year? 400 crore run rate every quarter?
Yes, 400, not 400 crores every quarter. Probably the full year we should be getting into close to 900, 950 crores of new order wins for the full year.
Okay.
All right. Sir, since we've already spoken about the exports, let's talk about the domestic market as well, because that's where you're seeing a lot of the strength come through. It was around almost 80% growth year on year that we saw on the domestic market. What do you expect on this going forward? And how much do you think is an achievable run rate for the full year just for the domestic business?
Full year, we should be growing close to around for 50%. And I think what we see, the domestic market is extremely volatile. And month-on-month projections are changing. It depends on day-to-day basis. We are working in the domestic market. We are unable to really project what exactly we are going to end up with. But for the full year basis, we can very confidently say that we should be 80% in the domestic market.
Okay. Mr. Jalan, realizations have inched up on a Y-on-Y basis. What is the headroom from here, both in the domestic and export realizations to move higher?
I think right now with the current commodity pricing realizations, we are going to remain pretty stable with what we did in last quarter for the full year or this FY23.
Okay. What is your current capacity utilization, considering the demand is strong?
Close to around 75%.
75%. And will it sustain at this level?
Yes, I think we are going to improve going into third quarter and fourth quarter.
Okay. But roughly, 75%?
If we see second half, we should have a utilization of close to 80 plus what we are looking at.
Okay, but currently, if your utilization is at 75%, is it not lower than the Q1 utilization of 78%?
No, if you see, we have plant-wise in our presentation, plant-wise, we have separated the utilization. And the biggest plant right now is, which was close to around 58%, is right now at close to around 75% plus.
Okay.
That's where the most of the revenue is coming in.
Okay, got that. Sir, now that we have you with us, could you also take us through what is the latest on the semiconductor issue? Of course, we've been speaking to a lot of managements, and they do seem to believe that, it is easing significantly. Is that what you've picked up as well?
Yes, what we see is a significant improvement in availability of semiconductors. And I think probably by the year end, we should be out of this completely.
Okay. Expect the situation to be completely normal by the end of this year in terms of semiconductor and chip shortage issue. Any debt reduction plans?
Yes, I think already in the first quarter, we have reduced our debt by almost 50 crores. And this first half, we should be above 100 crores of debt reduction.
And for the full year?
Full year, we are looking at close to 200 crores of debt reduction.
Okay. Thank you. Very much, Mr. Jalan, for joining in. So that's Ramkrishna Forgings saying demand in North America is very strong, likely to improve in FY24. Europe is seeing some initial signs of a slowdown, but not a lot. Overall, the company is guiding for revenues between 15 to 20% for the full year in FY23. The order wins are looking good. They're guiding for 900 to 950 crore of order wins for the full year, and debt reduction plan 100 crore in the first half of this year and another 200 crore in the second half of the year. That's Ramkrishna Forging for you. Get into a break. A whole host of stocks will be in focus on the other side. Stay tuned.
Hey guys, welcome back. You're still tuned into Trading Hour. Let's now talk about some individual stocks which are moving around in trade. M&M Financial is a big gainer today. It's up over 3%. And this is on the back of its August business update coming through. Abhishek is standing by with all of the details. Abhishek.
Well, M&M Fins released their disbursements number for the month of August. So for last 3 months in a row, they have had more than 3,700 crores of disbursements every month. So disbursements were at 3,740 crore for the month of August, which is up 75% YOY, but is down 4.5% on a month-on-month basis. So YTD, that is year-to-date disbursements, are at 17,150 crore, which is up 104% YOY. Now the collection efficiency remains strong at 96% in August. This compares to about 97% in the previous month. So stage 2 loans, or the overdues which are more than 60 days of dues, that has declined on a month-on-month basis, and stage 3 loans, which is the gross NPA ratio, has remained stable on a month-on-month basis. So the company has also mentioned that they expect stage 2 as well as stage 3 to improve in the month of September. Back to you.
Okay, thank you very much for that. Diagnostic companies are also on our radar. Brokerage house Antique has initiated a sell on Dr. Lal Path Labs and Metropolis. Nimesh is here with the details. Nimesh?
I remind, that's the reason why both the stocks are under pressure today, because Antique believes that the peak margins, the peak revenues are now behind for most of these companies. Now, they on Dr. Lal, they have a target price of 1643, a potential over 30% downside from current levels. And on Metropolis, they have a target price of 1232. Another 10 to 12% downside from current levels. Now, they believe that with increasing competition and the COVID-led, tailwind now behind, the industry is going to see a scenario of lower CAGR. In fact, Antique believes that the margins reported by these companies in FY21 will not be reported anytime soon and will revert to a long-term average growth of 10 to 12% versus over 15% seen in the last few years. Even on return on capital employed, Antique believes that it will now come down to 26 odd levels versus that 35% plus that they reported in the last few years. So there's going to be a sector, derating, and on back of that, they have initiated a sell call both on Dr. Lal Path Labs as well as on Metropolis.
Yeah, Nimesh, it seems to be a day of caution at brokerages, right? Because there's another big downgrade that has come in from Credit Suisse, this time on ABB.
That's right, and again, ABB has been a rank outperformer within that, capital goods stock. So the downgrade essentially is on back of a big run-up in the stock price and valuations getting extended. Now, so Credit Suisse has now downgraded the stock to underperform from neutral, and they have retained the target price of 2600. If you look at the stock price, not only in the last 1 year, the stock has rallied over 76%. But even in the last 3 to 6 months, the stock has rallied between 30 to 50%. So there has been a big outperformance within that capital goods space. Now, while Credit Suisse believes that, yes, the investment cycle is picking up, but, there has been a sharp run-up. The stock is now trading over 70 times FY24 price to earnings, and the multiples are capturing most of the upsides, and now Street is expecting a very high returns from year on in terms of earnings. Even on DCF, it seems to imply a 20% CAGR for the next 20 years, at a record all-time high margins of 12.5%. So on elevated valuations and a sharp run-up in the stock price in the last 1 year, Credit Suisse is now downgraded to underperform from neutral. They have a couple of picks in that capital goods space, so they maintain an overweight on L&T and they prefer Siemens over ABB from a valuation point of view. But on ABB, a sharp downgrade to underperform, and they have a target price of 2,600 on the stock.
Thank you very much for that. Another one that we're watching today is HCL Technology. The stock is holding up with a gain of 1.5%. This is also a brokerage note, but it's positive. So Kotak Institutional Equities met with the CFO of HCL Technology, and these are the key takeaways. The company is confident about achieving its FY23 revenue guidance of 12 to 14%. This revenue guidance for FY23 has a minimal contribution of acquisitions, which means it's largely going to be an organic growth. And Kotak says that HCL Tech will be amongst the few IT companies which will report an organic growth acceleration in FY23 versus last year. Demand, as per the company, is solid across all parts of the business in the near term, except for segments like mortgages and department stores. However, Kotak says that if there is a slowdown scenario, then FY24 growth for HCL Tech will come under pressure, which is why their estimates are that FY23 revenue growth will be 13.8% in constant currency terms within the company's guided band, but FY24 growth could be lower in high single digits. On margins, HCL Tech, as they had told us post the Q1 earnings, that Q1 margins have bottomed out. So it will improve from Q2 despite high attrition, despite some wage corrections which are going to take place. But, Kotak says that after the miss in Q1, the full year margins for HCL Tech, according to their model, is 17.8%, lower than the company's own guidance of 18 to 20%. Kotak says the stock trades, HCL Tech stock trades at an attractive valuation of 16 times forward multiple, which implies benign expectations and a dividend yield of nearly 5%, which is why they have a buy rating on the stock, and their target price is 1,165. So at least there is one positive comment.
Yeah, that's true. Let's take a break on that note. We have a lot more that's lined up for you. When we return, we'll get in the market technicals. Kush Bora will join in to talk about how the index is trending and also his top trading ideas. Stay tuned. Hi, welcome back. You're watching Trading Hour. It's looking good on the screen right now. So let's invite Kush Bora, founder of kushbora.com, for a quick tech check. Hi, Kush. Morning. Thanks very much for joining in. Let's start with your strategy on the index and then your individual stock picks.
Sure. First up, Sumera, thank you for having me on the show. Well, if you look at the data, then 18,000 and 17,800. These two strikes have a very strong base, when it comes to the call side, and 17,500 and 17,300 have, very significant basis on the put side. Now, the interesting thing is that there is a lot of call writing activity happening on the higher sides. Now, combine this with, the pressure that global markets are reeling under, this could keep the indices under check for a while. Now, once we get a breakout or a breakdown, beyond the range, do we get a clear, directional trend? On the Nifty, this is 17,200 and 17,800. On the Bank Nifty, it is 38,800 and 40,000. The good thing here is that, we're trading closer to the upper end, of the range. Now, Bank Nifty is becoming more and more Atmanirbhar. What I mean by that is, we're not relying on the FII inflows in the large private banks alone. In fact, if you take the last 2 weekly expiries, the PSU Bank Index has been the top 3. That's a positive. And SBI is now joining the party. There's a good chance that, we may break out of the upper range. But up until then, we advise, no trades on the Nifty or the Bank Nifty. A lot of action in the small cap and the mid cap space, and we expect that to continue in the coming weeks.
All right, that's what we've been seeing play out last week as well. But Kush, any individual names that you would like to recommend?
Sure. So, keeping in line with the, mid cap and the small cap, stocks and, that space doing very well, I have 2 picks, both on the buy side. The first one is Timken. Now, this stock is, one that we've discussed, on the channel, on the show for, a while now, from I think 2,000, 2,100 levels, and it's at, close to 30-50 right now. No signs of, this momentum abating. There was a brief dip in the stock, but that's turned out to be a buying opportunity. We expect this momentum to continue for levels of 33.50, and here the stop loss would be 3,200. The second stock of, a relatively smaller ticket size is Hoodco. This stock also has seen very strong momentum, over the last, couple of weeks. There are a lot of positive crossovers that are happening, on the stock price and on the moving averages. We expect this momentum also to continue for levels of 4,500. Here, the stop loss would be 40.5.
Thank you very much, Kush, for joining in. Need to get into a break. Here is a quick reminder for all our viewers. Money Control Pro's financial freedom offer is back with added benefits. Get a Money Control Pro subscription at a net zero cost by claiming exciting offers worth 1,500 rupees from our partner brands. Grab the benefits now on the Money Control app or website. Welcome back. This is our special segment, Global Spotlight. And one of the big stories globally has been Gazprom has announced an indefinite shutdown of gas flows through its key Nord Stream pipeline 1, which connects from Russia into the Eurozone, particularly Germany, citing leakage. Now remember, Gazprom pipeline was shut last Wednesday. Flows were due to resume just after midnight on Saturday or Saturday morning. But just before that, late Friday evening, Gazprom announced that it has detected a leakage on equipment during the Nord Stream 1 maintenance work, and therefore it will not be able to resume flows. The worry is that there is no time frame which is provided for the reopening of the pipeline. So the worry is that this could be indefinite. What Gazprom said is gas transportation to the Nord Stream gas pipeline has been completely halted until the complaints on the operation of the equipment have been eliminated. But the timing of Gazprom's announcement also raises the question whether Putin or Russia is responding to the impending imposition of a cap on Russia, price cap on Russian oil. Because the announcement just came hours after the group G7, the group of 7 countries, agreed to implement a price cap on Russian oil. Now, the West has been saying that Putin is weaponizing gas. The developments which took place about, Gazprom saying that we are not going to continue with the gas pipeline, at least for now. They've not given a timeline for the reopening, has once again provided fodder to their theory about Putin, weaponizing gas. Let's tell you who said what between Gazprom as well as Siemens. Now, Gazprom says that Siemens is taking part in the repair work in accordance with the current contract. It is detecting the malfunction and is ready to fix the oil leaks. Only there is nowhere to do the repair. Siemens, on the other hand, which is the German-based company, has refuted Gazprom's statement, saying that it was not carrying on any maintenance work but was available to do so. Siemens also said there are enough additional turbines available in the Porto Vaya compressor station for Nord Stream 1 to operate, the gas pipeline. But Russia is not doing so. So there is a bit of who said what and what the real situation is. But in response to, the fact that there is no gas which is being supplied to the Eurozone, the energy crisis is getting escalated. And over the weekend, Germany's government has agreed to a 65 billion euro relief package amid soaring energy prices. This would be Germany's 3rd relief package for the year. The previous 2 packages totaled about 30 billion euros. They included a gasoline rebate, which expired at the end of August, and there was also a transportation ticket. Now, with the 3rd, relief package, which has been announced by Germany, the total relief package this year is now close to $100 billion. So this is a story, of course, that we will be tracking very closely. Get into a break on that note. On the other side, we'll continue with our attention fixated on the global stories. We'll come back with interesting data on India's FI flow. Stay tuned.
General insurance companies, what they've sought from the regulator is a composite expense of management ratio.
The recommendation was there that why don't we have a single cap on the limit of expenses on management. So we have examined that report and accordingly a draft exposure has been put out.
Relaxing or removing the condition that private equity players can only invest through a special purpose vehicle or SPV.
Very soon we will finalize whatever we have to do as the private equity funds are concerned and the SPV, whether that is required or it's not required, can it be done away with. All of those are under deliberations.
IRDAI is considering giving a composite business license to existing as well as new insurance companies.
Composite license is not really an obstacle as far as insurance penetration is concerned. We need to amend the statute. So we are in discussion with the government.
Hi guys, welcome back. You're still watching Trading Hour, and let's now talk about an interesting story. We've been talking about India's outperformance versus some of the larger Asian markets. So if you look at the returns just for this year, they'll come up on your screen as well. So while something like a China market is down around 12%, Hong Kong, Kospi, Taiwan, all of them have seen cuts of between 18 to 20%. You have seen the Indian market, which has been very resilient, and it's actually up almost 2% in the same period. So we have Prashant, who's now standing by at the big wall with some interesting data on why we're seeing this kind of outperformance and what the flows picture is looking like as well. Prashant.
Well, thanks very much for that, guys. So, the argument is this. Does India deserve structurally higher FII allocation? I mean, that is the question that we're going to try and explore here. And this is something we've been hearing from many experts out there, both foreigners and Indians. Just a quick word on some here and now numbers. After selling $33 billion worth of stocks between October 21 and June of this year, when the market bottomed, since June, since the lows of June, July and onwards, FIs have bought back about $7 billion worth of stock. So they sold 33 and they've bought back about 7. Now, with those quick numbers out of the way, let me get to what the argument is. The argument that is being made is that allocations to India should be unbundled from other emerging markets, and hence FII allocation to India should rise. Now, this needs a bit of explanation. Let's first understand, when we say unbundling, what do we mean? How does FII money into India come? What is the route it comes in via? Well, 94% of it, or the FII flow, comes in via emerging market funds, global emerging market funds, EM funds, and others. The point is, 94% of the money comes into non-dedicated India funds. These are not India-specific vehicles. These are larger funds which allocate to other markets as well. So money goes into these and India gets a percentage of that particular money, 94% of it. What are the weights according to which once money goes into an EM fund, the fund manager allocates? They go with a benchmark, MSCI India, MSCI Emerging Market as an example. Well, what is the weight? These are the weights and these are the constituents of MSCI Emerging Market Fund. India has about just under a 13% weight. So what is the problem? Well, as you will see, and the next set of graphics will come up, around 75% of the MSCI Emerging Market, which is one of the larger benchmarks, is seeing some kind of pain or uncertainty. So just to go through some of the larger constituents, there is China, of course. There is zero COVID policy, which is hurting. There are other issues, government crackdown on big business, etc., etc. Taiwan is at the center of a battle between big powers, geopolitically speaking. South Korea, for a while we've heard that it could transition from being an emerging market, in an emerging market index, it could move into a developed market index. The chatter is it will happen in the next 12 to 18 months. Economic prospects in a large Latin American market like Brazil, they've dimmed sharply. The country's taken a turn to the right, and there are other problems associated with it. Saudi Arabia arguably is a one-stock market. There is Saudi Aramco, and South Africa generally is perceived as a low opportunity market. Russia now, of course, is completely uninvestable. It has been removed from the MSCI indices. So the problem is EMs as a category, emerging markets as a category, is hurting. And since India gets a portion, according to the weight it enjoys, a share from this larger pie, flows into India also suffer. Now, those making the argument that India should be unbundled from emerging markets also point to track record. India's returns track record over long periods of time, and I've shown 10-year CAGR, easily beats other markets. I think there is only Taiwan which is ahead, but you can see where the rest of the other markets are, the larger ones, that is. Growth prospects. So this is past returns, but future growth prospects vis-a-vis other emerging markets also don't need too much highlighting. It's well understood that India is in a better place, GDP growth-wise as well as compared to some of these other emerging markets. All of this means that many think India is a good place, is in a good place to attract larger share of foreign flows. What I hear from people and speaking with many, more than a few foreign funds and local sort of market participants who watch this space closely is that big investment boards around the world are starting to cap their investments into China. I mentioned China specifically because it's got a disproportionate share of these benchmarks. Some big asset allocators have started giving mandates for emerging markets ex-China. So, there is a structure created. It will invest into emerging markets, but not into China. The big question is China here, of course, right? Will China continue to hurt or will it abandon its zero COVID policy and, become more business friendly? All of this we'll know perhaps after October. Will Xi Jinping get a third term in October? I mean, I think it's going to be an important time in the year. Overall feedback is that a lot more money could come into India if not for the current very high valuations. And all told, structurally higher FI allocation can happen, but it is a process. This is the feedback. It's not a one-time thing. You should not look at what I'm presenting here and say, well, this is it. All the money which will come into emerging markets will come into India. It's not going to happen like that. These funds, these structures will have to be marketed and the story will have to be told. So that's what I'm getting at. I just want to leave you with one graphic which tells you what if you exclude in the MSCI Emerging Market Index. It's not going to happen like this, but just for the sake of it, if there is a structure without China, what would the corresponding allocations look like? India, which is at about 12.7%, would go up to about 18.5%. We're talking about, foreign investments into India at about $600 billion or so. I think a little less than that. What happens to that number? I mean, it's, in terms of percentage wise, you can take a look at that. We're talking about very large numbers, really. As I said, I just want to say once again, this is not a case to, this is not a presentation to say that India is decoupled from emerging market or India is not an emerging market. It's just to say that there is a credible argument, which I think holds water, that, India as an asset class, given past track record, long periods of time and future growth prospects, perhaps needs to be unbundled and looked at separately, especially given the fact that about 75% of the benchmarks right now being used are hurting, as a result of which flows into these structures are suffering as well. Back to you guys.
Very interesting analysis, Prashant. Thank you very much for joining in. We've got another call which is coming in from Christopher Wood of Jefferies. He says recent market movements and the renewed lockdowns in China prompt greed and fear to make asset allocation changes in the Asia-Pacific ex-Japan region relative return portfolio. He says the Indian overweight almost having become neutral, the allocation in India will be increased by 2 percentage points with the money raised by shaving off the weightage in China back towards neutral. So he's making an argument for money to be moved away from China into India. On that note, we also chatted with Mahesh Nandurkar, who is head of Jefferies, and he says the reason why India started seeing FI inflows in the last 1 month or so is because many investors tried their hand in China. They put money in China over the last 1 year because of low valuations, but they've lost money there. India, on the other hand, has been very resilient, which is prompting a lot of investors to once again shift their weightage away from China back into India. Listen in to Mahesh Nandurkar.
Over the last 12 months, there have been, 2 such occasions where people actually moved the other way around. That is, took money away from India and put more money into China. That happened once about 12 months ago, back in October last year, then again in May, June this year. And both these times, the investors did not really end up making money. So they really have a bad taste about going overweight on China. And India, by all means has done very well economically, fundamentally, and from the stock market movement perspective as well. I basically believe that right now India is clearly benefiting from that TINA factor, as I mentioned, that many of the large emerging markets are not really finding positive kind of flows from the international investors, and we are clearly seeing that after a long gap of nearly 8-9 months, where we consistently saw about $4 or $5 billion a month of net selling. The last 1 month has been very strong. But I don't want to take that flow for granted. That's what I can say.
All right, on that note, a very quick break. Up next, we'll talk about the market fundamentals. Joining in will be Siddharth Khemka, head of retail research at Motilal Oswal Financial Services.
Welcome back. Let's talk about individual stocks sectors. Siddharth Khemka, the head of retail research at Motilal Oswal Financial Services, now joins in. Siddharth, morning, and thanks so much for joining in. One of the stocks providing leadership today is Reliance Industries. It's up 1.5%. There was this big call made by Morgan Stanley. They say it's their top pick in the sector. They've put a target price more than 3,000 on Reliance Industries. But the stock is coming off a period of underperformance. Can you tell us your thoughts on Reliance? What is it that was troubling the street post the AGM? Because the stock corrected last week.
Yeah, very good morning, Rima. So if you look at, there was a big expectation out of the AGM from Reliance. So there are multiple factors that are going in and leading to this underperformance in the stock. One, the biggest expectation out of the AGM was any visibility or clarity in terms of the value unlocking. Investors have had enough patience of almost last 10 years of getting invested into the newer age businesses of that of Geo in the telecom and digital play and the retail business. And there was no such information forthcoming in the AGM, which kind of disappointed the street. But that was more in terms of expectation. But if you look at the core fundamentals, I think the big capex announced in the AGM, that is kind of a dampener. Although this capex will help the company in the longer term, their plans in the newer energy segment, their plans to launch 5G in the telecom business, having seen market leadership and the kind of maturity in the 4G growth now, I think transition to 5G is very essential. But at the same time, the huge capex, the 2 lakh crore capex for 5G rollout over the next few years, the 75,000 crore capex in the oil to gas plus new energy, I think that could dent the ROEs in the near term. We have seen ROEs in the range of high single digit, about 9.5%, which could get under pressure in the near term once this capex, because all these are capital intensive, high gestation businesses. So the returns will be back ended, will not see the growth or returns from these investments, but it will have an impact in the near term.
All right, Siddharth, good morning and thanks for joining us. You know, one space that we have been talking a lot about, of course, is the entire auto pack. It's seen a big run up. We also had the sales figures coming through last week. How do you approach this? Do you think that there's a lot more room left for these stocks to rally? And if yes, how would you approach this? Is it through the EV theme? Would you look at the two-wheeler pack or, pick some of the larger four-wheelers?
Yeah, Parvita, good morning. Auto is something that, again, after almost 1.5 to 2 years of underperformance, started seeing improvement on multiple factors. A, the improvement in the semiconductor supply chain. B, improvement in demand post the healthy monsoon, plus the upcoming festive season. So I think a lot of these stocks have run up. So our view on the overall auto sector continues to remain positive. However, if you are looking at a fresh entry, I think the risk reward is not that favorable at current levels. Any dips because of whatever is happening in the overall market can be a good entry opportunity. If you look at what are the preferred plays, I think one has to be positively looking towards the passenger vehicle segment, which looks very interesting given the upbeat festive season, the strong pent-up demand, as well as the improvement in the semiconductor. So in that space, obviously the preferred pick is Maruti. If you look at some of the other players, like M&M has been also doing very well with their new launches. And Tata Motors clearly in the domestic business has seen sharp improvement in the domestic, mainly because of their strong performance in the EV space, which by far they are the leaders. Within the two-wheelers, I think there are selective plays, but I think a lot of the stocks have run up. One can look at Hero Moto or an Eicher at this point in time.
Siddharth, what about the hotel stocks? Now, Indian Hotels has made a fresh 52-week high. EIH was at a fresh 52-week high just last week. Lemon Tree is very close to those levels as well. Now, urban consumption has done exceedingly well. Despite the inflationary pressure, travel is back, occupancies are high, hotels have managed to increase the average room rent as well. But after the kind of run-up that we've seen in the stock price, Indian Hotels has doubled in the last 1 year. Is the risk-reward still favorable?
So, Rima, if you look at what is happening is that some of these niche consumption sectors are doing well, be it the QSRs, be it the retail, be it the hotel space, and rightly so, because after a long period, I think the sector has seen sharp improvement in demand, in occupancy, as well as in the ARRs, and that is the benefit that these companies have these stocks have seen as a reflection. As you rightly highlighted, the risk reward, at least in terms of Indian hotels, at this point in time, we are positive, but doesn't look that good. If you look at Lemon Tree, that has corrected from its highs and is relatively better placed in terms of risk reward. So the company is also preferably positioned within the business destinations, with 86% of its inventory focused towards business travel, where we have seen a sharp improvement. Plus, if you see, the focus is growing with the asset-light model, the management contract model, which is kind of keeping the balance sheet pretty strong. So we are expecting a strong revenue growth of almost 50-55%, with margins improving. EBITDA is expected to grow almost 85-90% over the next 2 years, leading to an improvement in ROE. So I think at this point in time, would prefer a mid-cap player like Lemon Tree within the hospitality space.
All right, Siddharth, we'll leave it at that today. Thank you very much for joining us and taking us through your call on all of these individual sectors as well as stocks. It's a wrap on the show. The market is holding up quite well. It's 0.6% higher on the Nifty, so that's looking quite positive. The Nifty Bank is where you're seeing a lot of the strength come through, so that will be up for you around 0.8% there. But it is really the metal stocks which are shining in trade. All of the top gainers today, Hindalco, JSW Steel, Tata Steel, all of them doing extremely well. With that, we're going to wind down on this edition of Trading Hour. From the entire team, thank you for watching, and Halftime Report comes up next.